Hi, and welcome to the Elphinstone Research Group. In this series, I want to discuss fixed income securities. Today, I want to build up the very basics of what the fixed income essentials are, and over the next few sessions, I hope to build up to teach you how you could begin to value fixed income securities. The fixed income world is massive, and I think to kind of strip away the big details, I think the key important elements which we should focus on today are the features of fixed income securities, which are the typical technicals that people have heard of previously. But also for the day-to-day investor in fixed income, it's very important to understand the legal, regulatory, and tax implications, as well as contingency provisions. So to work on these one by one, we start off with features of fixed income securities. So to explain what a fixed income security is, in its simplest terms, a fixed income security involves someone who wants to borrow money, and this borrower will typically go to the fixed income market and issue bonds. And these bonds are typically very similar to how a loan would look like for a household. So you may think about, for example, a government, supranational agency, wanting to generate millions of dollars, which they don't happen to have lying around. So they may go to the bond market and issue these bonds, which effectively are just kind of small packages of loans. And bondholders can decide to buy these bonds. And when you buy a bond, you're effectively giving this loan amount to the company, the government, the supranational agency in return for holding this bond. And over the lifetime of that bond, this firm who's borrowed from you would then pay you kind of interest payments in the same way a loan would work. And these things are called coupons. And these instruments, as a result, have a lot of behaviors which are very similar to loans and mortgages. But of course, the size of these things means that they behave in very interesting ways. And because of the fact these are kind of lent out by companies, they have very different structures to the typical, for example, mortgage, which everyone sees day to day. So to start off with some of the key kind of terms you'll see, I think the most important thing to start off with is the issuer. This is the person trying to borrow money today. And the examples of this include supranational organizations, non-sovereign governments, quasi-government entities, and companies. And I think a natural question to ask is, why should we care about the issuer? And it comes down to something called credit risk. Credit risk, you can think of, is a probability that someone doesn't pay you back, i.e., you've now lent them this money as part of this bond, and they come back to you and say, we're not paying you back, we default. That inherently is a risk to you, because you've just given them money which they're not paying you back. And as such, you're not making money or any return on investment. And this comes down exactly to the issuer. So it's very important to get an understanding of who is the issuer, what are their cash flows, how trustworthy they are, and as such get a judgment of their probability of paying you back. And luckily, there are agencies called credit rating agencies whose exact job is to do exactly that, to give ratings for all of these companies, firms, governments, and rate them on how likely certain instruments they allocate and issue are to pay you back. And to show you an example of this, these are the classification tables for three of the biggest rating agencies. And to kind of explain this table in a piecewise way, if you look at the first row, you can see there's three key companies who do credit ratings, who are Moody's, S&P, and Fitch. These are three companies which you'll see, for example, if you go into Canary Wharf, for example, they're big companies. And their role is they kind of have a company, a government, an agency come to them and say, if you want a credit rating, and they'll pay them a fee. And Moody's, S&P, Fitch will then go into their accounts and understand what are their cash flows, how reliable are all of their debt instruments, and they'll come back to them and they'll give them a credit rating. And this corresponds to the three columns which you see in blue. So these ratings could be anything from AAA, which is the top row, all the way down to the bottom row, where it is D. AAAs are the least risky credit rating. You can almost think of these things as being risk-free. Whereas right at the bottom for D stands for default, which basically means you're not going to get the money back. And in the fixed income world, people try to kind of make a separation between the ranges of these ratings, which is what you see in the left column. Anything between AAA down to BAA or BBB are called investment grade, whereas anything below that are called junk. And as a result, that boundary is very important for how trustworthy the money is in terms of the money you're lending to these firms, government agencies. This all said, I think it's important as an investor to know that you shouldn't take these ratings as your only source of information about the credit risk. The reason I say this is because credit rating agencies have had criticism for two key reasons. The first of which is the fact there's an agency problem. As I mentioned earlier, these companies, these governments who want to get rated, go to Moody's, S&P, and Fitch and pay them a fee to be given their credit rating. But as a result, there's a conflict of interest kind of nested in that, which is that each of these companies' own revenues are tied to the fact that they're giving out these credit ratings. So let's suppose that I go to Moody's and say, "Oh, I've made a company. I want you to give me a credit rating." And Moody's comes to me and says, "Okay, your credit rating is B1, so I'm in junk." I'm going to be very upset with that rating. I'm going to think, why am I junk rated? And as a result, I may decide, okay, next time I go to get a credit rating, I'm just going to go to Fitch. And hopefully Fitch will give me something better, maybe a BBB minus. And as you can see, there's a conflict of interest there. Because now, Moody's, knowing that, will be kind of tied to giving me a better rating as a result of that. And as a result, you're painting a picture about the credit risk of my company in a much more optimistic way than it truly is. Furthermore, this was exactly what happened during the 2008 financial crisis. An example of fixed income instrument are mortgage-backed securities, which, to kind of skip all the technical detail, you can think of a mortgage-backed security as pooling thousands of mortgages into one instrument. So by buying a mortgage-backed security, you're actually exposed to the behaviors of 1,000 mortgages. And at the time, credit rating agencies were giving ratings which were very high, even upwards of stuff in the A range, which paints a picture as very low credit risk. But actually, when you look at these individual mortgages, which made up those 1,000 mortgages, a lot of them were in default. A lot of them are subprime, which means that they're very kind of badly made loans, which in theory, no one should have been lent money for that mortgage. And their delinquency rates were really high. And their delinquency rates are the rate at which people are behind on their payments, i.e., the ratings for these things were very high. But when you actually looked at the behaviors of these mortgages, they were pretty much already junk. And investors who were just trusting these credit ratings were investing in these things as if they were safe assets, when in reality, they were nothing close to that. And as a result, at the onset of the financial crisis, a lot of these kind of banks, these investors who thought they had their money in something safe, actually saw a lot of their money being wiped out. And alongside that, one of the things that credit ratings don't properly account for are the correlations in assets. As, for example, when one mortgage decides to default, you may think it's a kind of like an independent process. So none of the other mortgages will start to default, which in this case is one of the big reasons the mortgage-backed security market arose. But one thing these things don't account for is when, for example, 50 of those 1,000 mortgages have defaulted. In that scenario, there's a very strong correlation. If 50 mortgages are defaulting, it's a very high likelihood that another 10 are going to default. That's exactly what happened. Once a couple of subprime mortgages started to default, a lot of them did as well. So these mortgage-backed securities lost a lot of money on the back of that. So the key point that I want to get across is you should take these things with a grain of salt, and you should be doing your own form analysis to understand the behaviors of the issuer and to also account for the correlations that a fixed income instrument in your portfolio may have with the other instruments in your portfolio. The next concept I want to talk about is maturity. And any bond has a maturity date. So in the same way that when you take a loan out, let's say from your local bank, you have a date by which you have to pay back the face value. And in the exact same way, a bond will have the exact same notion. So the maturity date could be anything from 3 months' time all the way up to 30 years into the future. And this means that at that date, you're going to pay back the face value of that loan. And the type of loan can be kind of classified based on its maturity date. So bonds which have a maturity date with less than 1 year are typically said to be in the money market, where stuff more than 1 year is said to be in the capital market. Furthermore, you actually have some instruments which don't mature, i.e., they kind of pay you coupons infinitely, and these things are called perpetuals. And one example of this are consols in the UK. Another concept I want to talk about is par value, which is also called the face value of the principal, which is the amount the issuer repays to bondholders at maturity. The reason we touch on this concept is because bond prices are typically quoted as a percentage of par. Namely, you can think of this kind of being quoted per $100 of par value, which means for every $100 of money that you had to pay back at the maturity date, how much is that worth today? So if I quoted you 95 for a bond per $100 of notional, or you could say par value at maturity, this means that if the face value was $100, then I'll be paying you $95 for that today. Or for example, if at maturity I'm being paid $200 now, you'll be paying today 2 times 95, so $190. And importantly, you have to look at the pricing relationships of the quote for the price today relative to par, because it gives you interesting information about the bond. So typically you would say that if the price is below $100, or the quote is, you're trading at a discount to par. If the quote is exactly 100, then you're trading at par. And if it's higher, you're trading at a premium to par. And as you come to see, once you get to some of the kind of key results of evaluating bonds, for example, it happens to be, for example, that if a bond is trading at par, it means its coupon rate is equal to its yield to maturity. And this touches on to the coupon rate. So in the exact same way, when you take a loan out, you have to pay kind of regular interest payments. This exact same concept carries over to coupons and to bonds as well. And this is called the coupon rate. So the coupon rate is typically an annualized rate at which your interest rate is your interest payments are calculated based off. And you have different frequencies of which these are paid off. So for example, if you have a 6% coupon rate, it means over the year you'll be getting paid for example, $1,000 of face value, you'll be getting paid $60 over the entire year. And the frequency of this actually matters. You may think that it doesn't truly matter what time of the year you get paid. But as we know, the time value of money is important. And the difference between getting paid, for example, once at the beginning of the year, or twice, one time at the beginning of the year, then one halfway through the year, it's quite different, because you have to then discount the value of that kind of $30 that you would have got 6 months from now. Whereas you've got $60 today, you don't have to worry about that discounting. So actually $60 today is more valuable. And there are also kind of typical examples of this, which include vanilla bonds, floating rate notes, where the floating rate note is in its name. The coupon rate is floating. It's typically pegged to some form of reference rate. So examples of this would be SOFR, SONIA, which are kind of rates which you'll find for the interbanks in the US and the UK. And then plus a spread on top of that. So this could be anywhere from 50 basis points typically up to even kind of 250 basis points. There are also instruments called zero coupon bonds, which, as in its name, its coupon rate is 0. Which means that if you think of it at an intuitive level, if you're not being paid an interest payment kind of regularly, you'd hope that when you pay for this instrument, you'll be paying a discount to par, because otherwise you wouldn't be making a return on investment as a result of that. Another important consideration is the currency denomination, especially, for example, if you're investing in overseas. The reason for this is there's a lot of risks attached to FX, which could mean that maybe your thesis was correct, that this kind of bond is going to perform really well, and it did, and it made you a lot of money. But you may lose a lot of money if, in the background, there's been a lot of FX vol. And as a result, actually, you've lost money through your FX view. So actually, all of your P&L was just wiped as a result. So it's important to kind of factor in, are you taking on FX risk? And the key problems to think about is the liquidity in the asset. Is the FX even freely traded? Um, and actually, there are different types of bonds which account for that. So you can have dual currency bonds, which is where the coupon payments are made in one currency and then the face value is made in another, or currency option bonds. And just to illustrate kind of why may a company think, I want to issue a dual currency bond. Suppose I'm a Japanese company and I've got a massive kind of business which is kind of booming in Japan. And now I want to start working internationally. I want to build out my business in Europe. A good company of this would be, for example, Entity Data Group, who were massive in Japan and wanted to then move into the UK market, especially in data centers. And your money, which is generated for, you want to kind of allocate bonds in the local currency of the EU, so the euro, in order to invest in these things. But you don't be paying your interest rates in euros because you haven't got any cash flow in Europe yet. Right now, your entire business is in Japan. You're making yen. So a natural kind of idea is to take out a dual currency bond. So today and over the lifetime of this bond, you're paying back in yen, which of course you're generating because your business is booming in Japan. You've got all this cash flow coming in, so you're paying off the coupons. And then hopefully after 30 years' time, you've got this business kind of booming now in Europe. You're generating all this cash flow, which means that at the end, when you get to maturity, you have that kind of money in euros to then pay off the face value. So in that sense, you can see how dual currency bonds can be really powerful. For example, in the case of someone or company trying to move overseas. So to kind of wrap up with an example of a fixed income instrument, you can think about a 5-year Japanese government bond. And its coupon rates are always pretty low because the Japan reference rate is always very low. So you can see it's 0.4%. And we can say that the face value of this thing is 10,000 yen. So you know that the annual payment for this thing will be 0.4% times 10,000 yen, which comes out to being 40 yen per year. And you can think, okay, what are the cash flows then associated with this? And this is what this diagram is showing you. So on the left hand of this, you can see the very leftmost point is the cash flow today. So today I've just spent 10,000 in order to enter this position. And then every half year I'm receiving 20 yen. This corresponds to the fact that this bond is semi-annual, so I'm getting paid 2 times a year. So if annually I'm receiving 40 yen a year, that means semi-annually, so twice a year I'm receiving 20 yen. And you can see because it's a 5-year Japanese government bond, I'm going to receive 10 coupon payments over the lifetime of this bond. And finally, at the very last time point where I'm getting paid, this is at maturity now. So at the end of the 5 years. So at this point we mature. So I also receive my 10,000 yen face value back. And this would summarize the exact lifetime of a fixed income security. So finally, I want to kind of touch on the idea of yield. And yield in itself is quite a complicated concept. So I will kind of return to this later on. But to introduce 3 kind of measures of yield, the current yield is measured as the annual coupon/bond price. This is almost analogous to the dividend yield for common shares. You also have yield to maturity. This can be interpreted almost like an internal rate of return on the bond's cash flows. So this is kind of the discount rate that equates the present value of the bond's expected cash flows until maturity with its own price. And as we'll come to see in kind of future sessions, the yield to maturity depends on what's called the compounding frequency. So to kind of give you an intuitive grasp of this, you can think about how often do you want to receive your rate of return per year. So if I offered you, for example, you could receive a 10% return once a year, which means that today, so the day you receive this 10%, if you gave me $1, I'll give you 1.1. Or the alternative is I offer you is you can get a 5% rate of return twice a year. So you can see kind of 5 times 2 is 10%. So I think the naive interpretation of this is you get the same payment, right? either get 10% for a year or 5% twice. But actually, they're different. If you receive 5% twice, so if you gave me $1 today, the first time I give you the 5%, you're now going to have 1.05, 1.5, no, 1.05. And the second time you come back to me, you're getting 5% on the 1.05. So you can think, if you split up to the $1, so that $1 you had earlier, I'm getting another 5. But you're also making 5% on that 0.05. So actually, you're making more money than the case where you received 10% one time a year. So as a result, when you're thinking about quoting your yield to maturity, you got to be careful because it depends on the compounding frequency of that rate of return, where compounding frequency is the number of times I pay you in the year. So in this case, being paid 5% once a year, so your compounding frequency is 1, compared to being paid 5%, for example, an infinite amount of times a year, which is where your compounding frequency n is infinity, are very different things. So you have to be very careful when you think about these concepts. And I want to move on to the legal, regulatory, and tax implications. The way you look at a bond, so imagine you want to invest in this kind of government bond or a corporate bond. The kind of key document to be looking for is called a bond indenture. This is the trust deed, and it's a legal contract that describes the form of the bond, the obligations of the issuer, and the rights of the bondholders. So in many ways, this kind of lists out exactly, for example, the coupon rates, all the kind of concepts I mentioned earlier, but also more of the legal side as well. So namely, I think some of the interesting parts are the contingency provisions, the funding sources, i.e. where is the kind of cash flow which would be paying you back, where is it coming from? And other concepts such as collateral, credit enhancements, covenants. And to briefly introduce these concepts, collateral is kind of an asset which the issuer can provide, which means that if I default, you can have the collateral. It's almost in a way like some form of insurance that the issuer is giving the other person. And as such, you can kind of think intuitively, it's a bit more of a safer investment, the fact that if this person defaults, I get something in return. Secondly, I have credit enhancements. These are kind of options which are kind of provided either internally or externally to the issuer, which makes a credit rating higher. And finally, you have covenants. These are kind of restrictions that can be placed on the issuer to ensure that you can kind of maintain their creditworthiness. It's almost a way of kind of surveying to make sure that this company remains kind of prudent about its cash flows and its creditworthiness. So, for example, a covenant might be that the company can't issue any more debt after this point. Or a more common one would be that the debt equity ratio as a company can't exceed some kind of given number. And as a result of this kind of legal frameworks, you typically wouldn't see any given one bondholder kind of surveying this bond and their legal responsibilities day to day. So if I bought a Japanese government bond today, I wouldn't be kind of checking on whether the Japanese government bonds cash flows are correct and whether they're actually being generated to pay back my coupon payments, for example. Rather, you typically kind of allocate that role to what's called a trustee. Typically, banks have these kind of trustee divisions. So you have a trustee bank who does this for you, where you can house your bond with the trustee, and they'll be the one chasing up the issuer to make sure that they kind of stick to the obligations which are specified in the indenture. They also kind of maintain the key documentation and records, which then are given back to the bondholders, and also appraising the collateral. So to summarize what an indenture does, it kind of tells you everything you need to know about the bond. Everything we covered in the last section, but also other things, including the legal identity of the bond issuer, the sources of repayment, the assets and collateral, the credit enhancements, and the covenants. And I think one of the things I want to touch on is namely the legal identity of the bond issuer. So as we mentioned quite thoroughly in the last section, the bond issuer matters a lot, but also in the covenant, you got to be careful about the legal identity of the bond issuer, namely the kind of difference between the legal issuer and the issuing body. So the issuer is defined in the indenture by its legal name, And the legal issuer and the issuing body may be very different things. So the issuing body is the person who's actually needing the money, who's going to use the money. But legally speaking, the issuer might be someone else. So kind of to give you an example, the UK gilts are issued by the UK DMO. When it comes to the actual repayment obligation, that comes down to HM Treasury. And to use an example with corporate, for example, you may have a subsidiary who wants to be generating some money through bonds, but it may be that, for example, the legal issuer is the parent company or vice versa. And these have real implications, for example, on the credit rating. So it could be that a parent company has an incredible credit rating, whilst the subsidiary has a terrible one, or even vice versa. So you have to be very careful about, let's say they default on this bond, which legal company is liable to, for example, paying you back. And hence, kind of, in the case of like liquidation, who are you getting the money from? And it comes down to kind of, I want to kind of talk about a special case, which are called SPVs, special purpose vehicles. So to talk about a kind of special structure where this may matter is, let's talk about mortgage-backed securities. The way mortgage-backed security works is you create a special purpose vehicle. So you can think of this as this kind of own company. And this company is kind of built under this kind of framework, which is called special purpose vehicle. And what happens is, as I mentioned earlier, mortgage-backed security involves kind of holding 1,000 mortgages, let's say, in one go. And typically, for example, a bank will be able to hold 1,000 mortgages because when I want to go and buy a house, I'll go to my local bank and say, can I have X amount of money to put down on a house? And when I take out that loan, I'm effectively selling that mortgage to the bank. So now the bank is holding onto the mortgage. So this bank then thinks, okay, I want to then resell these mortgages out as mortgage-backed security. In a way, this helps the bank offload that risk. And they have two options for that. They could either package it in-house and sell it on the back of the firm, or they can use a special purpose vehicle. And the benefit of using special purpose vehicle is it's something called bankruptcy remote, which means that if my local bank decides to default, then that won't relate to this mortgage-backed security because the special purpose vehicle is its own separate legal entity to the bank, which as such means that the credit risk of this mortgage-backed security wouldn't be tied to the credit risk of the bank. And that's one of the key advantages of special purpose vehicles. When you think about, I want to invest in this mortgage-backed securities, the only thing you should be thinking about are the quality of the 1,000 mortgages. You don't have to worry about the legal company which these things originated from. And these things are kind of the technical term, they're called sponsors. So you can think of the sponsor as kind of selling these mortgages to the special purpose vehicle, and the special purpose vehicle is then who packages up into a mortgage-backed security. And these are then sold off to investors. Another key point is then the sources of repayment. So this really depends on the issuer. So this, for example, for a supranational company, could be through kind of previous loans they made or being paid in capital. National governments may provide kind of explicit guarantees, all the way up to kind of corporate bonds, who may kind of use their own operating cash flows to generate it. The key point is you have to look at the very specific case of the company you're trying to invest into and really get an understanding of their cash flows. How sustainable are they? Are they long-term or short-term? And as such, you come to a judgment about, do they have the relevant cash flows in order to pay back these kind of bonds that they're got issuing out? And as you mentioned earlier, you also have asset and collateral backing. And as I mentioned earlier, it's almost like a form of insurance. So if the company decides to default on you, you then get hold of the collateral. So to give kind of a typical example to maybe make it easy to understand, with a mortgage, the typical collateral for a mortgage is the house. So if I took out a mortgage to buy a house in my local area and I get made redundant, I haven't got cash flow, suddenly I can't pay my mortgage. So I default on my mortgage. This means that the bank is going to come knock on my door and say, this house is now mine. And as a result, the bank, they lost money because they gave me this mortgage, I didn't pay them back. at least now they've got this house as an asset, which they can hopefully resell to make back some of that money. And typically in the kind of fixed income world, these are called secured instruments. And just to kind of touch on that point about the bond indenture, collateral will be specifically kind of outlined in the bond indenture. So again, this is one of the important reasons you should be looking at that bond indenture to understand the quality of the collateral and to kind of understand, for example, is an amortizing asset, will it depreciate? And as a result, you get an understanding of your own return on investment based on, okay, if you defaulted, how much money you're truly getting back, for example. And when you think about collateral and kind of the case where a company goes into liquidation, it's really important to understand where do you stand in the seniority ranking. So what this means is when you invest, for example, in let's say a company. So again, let's go back to the example of my company. Let's say I run some mines in Africa, and of course, there's kind of huge costs in kind of getting these mines up and running, the equipment, etc. And as a result, I decide to allocate some money through bonds, but also through equity. And of course, as I mentioned earlier, the fixed income world is massive. So I may offer different types of fixed income assets. Namely, as you can see in the diagram, you have senior, secured, unsecured, you have junior debt as well. And namely, okay, let's say my mining company does terribly, I don't make any money, I have to default. In this case, now I owe money to my senior debt holders, my secured debt holders, my junior debt holders. Who gets paid first, right? So, and these are one of the key risks to consider because the order you get paid back is really important as well. And the way this is decided is through a seniority ranking. This is almost like a pecking order, which says in this exact order, people get paid back. It's almost like a waterfall structure. So, firstly, we go to all of my, in this case, as you can see in the diagram, the first people to get paid back are senior debt holders. So, with the kind of scraps of money that I've left after my business has died, I go to the super senior debt holders and say, okay, I have this amount of money. Can I kind of cover the amount that I owed you? If so, then I pay them back. And whatever left over, I then go to the super secured, pay them back. And you, as you say, it's kind of waterfall structure. You just kind of pay all the way down until you don't have any money left to pay people back. So as a result, this is another key risk to consider. You want to think, where do you sit in the seniority ranking? But of course, the lower down you sit in the seniority ranking, you can think that you have a higher risk premium. Are you demanding a bit extra kind of expected return exactly because of the extra risk that you're taking on? And in this case, there's loads of different types of collateral backing. So, for example, you have collateral trust bonds, which are secured by securities such as common shares, other bonds, or other financial assets. You also have equipment trust certificates, and also covered bonds. And again, these all have different kind of specifications and the way they work. And the easiest way to kind of think about these things is based on the specific kind of background of the company, the government. They may have very specific needs on how they generate for example, this money to ultimately invest in a project, for example. So just an example is like that Japanese government, that Japanese company, which I gave the example for the currency bond earlier. Similarly, you may have kind of specific contexts where a government wants to generate money. And as such, they may want a covered bond, equipment trust certificate. So the easiest way to learn about these things is look at these kind of very specific contexts where these things have been allocated in the past. Then we also have credit enhancements. So credit enhancements, as I mentioned earlier, are a provision that can reduce credit risk of bond issues, and is often used for securitized bonds. Securitized bonds are type of bonds where you've it's like a mortgage-backed security, where you have an underlying asset. So it could be a mortgage, it could be car loans, it could be credit card payments, and you then bunch them all together. So in the same way that I said, we have 1,000 mortgages which we've bunched together for mortgage-backed security, you can then bunch together 1,000 car loan payments. You can bunch together 1,000 credit card payments. And these things can then be sold as a product in of itself. And of course, these things have credit risk, and credit enhancements may provide additional ways to make it a bit less risky. And typically these things are classified into internal and external credit enhancements. Obviously, kind of intuitively, internal is related to the features of the instrument, the SPV, for example, whereas external can be kind of externally guaranteed, for example, by banks and other companies in forms of insurance. And the three key examples of credit enhancements are subordination, over collateralization, and excess spread. And I think the most kind of common examples of this, for example, we mentioned earlier, subordination is the waterfall structure, which is where you kind of structure the seniority ranking in exactly the right way so that people kind of can allocate themselves into the right risk kind of category. Over collateralization is when the kind of collateral value actually exceeds the face value of your debt, which means that, for example, if we're talking about a mortgage-backed security, the mortgage, kind of the SPV that holds these mortgages may say, okay, we've got $120 million of collateral. So you've got this kind of extra 20 million of collateral on top of your 100 million. And it's, in this case, it kind of adds kind of some sense of kind of security that you get some of your money back. But you have to be careful in those scenarios because you can think, okay, so we've got collateral $120 million of mortgages, which are backing $100 million notional of mortgages. So what can go wrong? And then you kind of think, and you think that, okay, let's think about the financial crisis. What happened? A lot of people defaulted on their mortgages, and you can think suddenly these 100 million, this kind of face value, $100 million of mortgages, over the space of 6 months, would have tanked. It'd be worth 20 million. So then you think, okay, so we've been given this $120 million of collateral, so we've been over collateralized. But then you notice, okay, so if these underlying mortgages were then to tank, so exactly in these cases where these kind of states of the world where things have gone horribly wrong, i.e., when you really need this collateral to be there, suddenly the $120 million is actually now worth $50 million. So actually, you got to be very careful. So looking from the point of view of today, you think, okay, I've got $120 million of collateral, I'm chilling. But actually, exactly in those states of the world where you need this collateral, there's no guarantee these $120 million of mortgages will still be worth $120 million. They may themselves have tanked. So be very careful about those risks that you're taking on exactly because of these kind of the things you're trying to hedge against. And the final thing is excess spread. So you can think about the kind of recurring cash flows of these instruments. So for example, with the mortgages, it's the mortgage payments. And the SPV may decide to hold a buffer on the back of that. And these act as kind of an extra cash pool which can be used. That summarizes exactly everything I want to speak about today. So next session, I want to then talk about contingency provisions and to then, after that, talk about how we can then go on to value these sort of instruments in practice. Thank you for listening.